Hi there, Chevron employees. Welcome and thank you so much for being here today. I'm Sam. I moderate these presentations, and in just a second, we'll be joined by Wesley Boudreau. Wesley is here today to speak to you about some strategies you can use if you are hoping to retire early from Chevron. There are definitely some strategies you can use, and he is very knowledgeable in those, so he'll be covering those with you in just a few moments. But I wanted to very quickly remind you that we are not Chevron here, so please keep that in mind as you're listening along. We are an independent group of financial advisors, so please remember that. Next, I'll be entering some links throughout the presentation. They will pop up above your head. If you're watching this on YouTube, they will be in the description box below. Click directly on those links. They're going to guide you to our website. You can book a free 15 or 30-minute block of time with one of our Chevron-focused advisors. You can also subscribe to our newsletter and read our blogs. You can also follow us on YouTube and on LinkedIn. We post a lot of content for Chevron employees and retirees, and we really feel you'd get value out of it if you considered giving us a follow. And if you do, thank you so much in advance. And without further ado, let's jump right into it with Wesley Boudreau.
All right, thank you very much for that introduction, Samantha. And like she said, we're going to be digging into some different topics that are really focused on how to potentially access your 401k or maybe IRA if you're actually under the age 59 and a half, which is kind of that golden age that the IRS has instituted, where you've set up these retirement accounts and you're truly trying to save those for retirement. And if you don't, if you actually touch it prior to 59 and a half, generally speaking, there could be a 10% penalty. We'll go over some different circumstances where you can avoid that. So again, doesn't mean that you should access your account because there are some different ways to get around that 10% penalty because obviously there's also issues with opportunity cost, looking to keep that in there, let it grow. So we'll go over some different items like the Rule 72T, which is substantial and equal periodic payments, Rule 55, which is a big one for 401ks, some other different specific issues, and then how you kind of tie all this into a plan to make sure you understand what you're actually looking at and maximizing your benefits in the long run, not just the short run as far as a potential need for some of those flows. So whenever we do retire, there's potentially some different income sources that you could have. I would say that the left-hand column, hopefully we're all going to have. Obviously, a lot of concerns are around Social Security. There's a couple things they can do to tweak that to actually extend that into 2090s or so. So I don't think there should be too much concern about that. Maybe a means testing would be the worst case scenario later in life. But we are going to retire with the ability to take Social Security anywhere from age 62 to age 70. At the retirement group and wealth enhancement group, we can actually run a full analysis to show you the different claiming strategies and help you determine the best option for you. And we've also got our own savings, whether it be investments and savings that we've set aside through a 401k. Hopefully, we got some company match there. Maybe we've saved outside in a brokerage account, our own IRAs, Roth IRAs, appreciation of a house if we sell it, things like that. So those are two things that most of us should have. On the right-hand side are things that maybe we could have as well. If you're lucky enough to still be working at a company that has pensions, a lot of those have gone away in the past, obviously, but that could be an additional income source, whether it be that you're taking the income as an annuity payment, or whether you take that and convert it to a lump sum calculation, roll that over to a IRA or 401k, and take distributions from there. Any questions on that, we can dig into it as well because we do a lot of work with companies that do still have pension plans, actually. And it may be that you find yourself retired and you realize, hey, my spending is higher than what I thought, or inflation's crept in, and you got to go out and get a job, or maybe you just have a job for enjoyment. Maybe you want to work at the hardware store, part time just for something fun to do, or maybe you want to volunteer that doesn't pay. So these are the potential income sources you could have. But again, for those of you that may be finding yourself deciding to retire early, or unfortunately getting cut by a job under 59 and a half, there may be some other issues as far as how to access those funds. And that's what we're going to dig into and talk about. One of the reasons we want to dig into this is because a lot of money is set aside in 401k plans at this point. Right now, just shy of about $9 trillion is set aside in 401k accounts. Probably it's probably over that since these numbers came out. Another issue is there's a lot of 401k plans out there, about 600,000 different 401k plans. So that's different companies that have 401k plans where you can make those contributions, and hopefully there's some company match in there as well. Right now, about 60 million Americans have our participants in 401k plans. So again, 600,000 different plans, and about 60 million of us actually have money in those plans. And about 54% of U.S. adults have either a 401k or a 403b plan. So about half of America does participate in those retirement plans. And about 18% have outside accounts like IRAs or KIOs, which is kind of like a self-employed retirement plan there as well. And 19% of the 401k investments are index funds. Now, I'm not going to get into the investment side of it, but a lot of different 401ks have a default either index funds or age-based strategies and things like that. If you ever need to review your specific 401k and want to run through and figure out, okay, Wesley, am I allocated correctly? Should I make any changes for my risk tolerance and what my goals are? We can go through that with you as well. And here at the Retirement Group and Wealth Enhancement Group, we actually have the ability to potentially tap into your 401k and manage that for you if you need that help and that guidance beyond just a little bit of advice. As far as why do I need to know some of this stuff? We looked at the numbers, and you'd be shocked and surprised at how many people actually paid the penalty last year, or not, excuse me, 2 years ago in 2023. About $6 billion was spent on the tax penalty. So again, we'll show you in just a moment. But if you take a withdrawal prior to 59 and a half, there potentially could be a 10% penalty. So again, our job is to help make sure that if you do need to tap into that, again, we would probably suggest pushing that if you can, but if you need to, let's at least avoid that 10% penalty, not be part of that 6 billion that was lost in 2023 just to penalties alone, not taxes. So again, like I said, first and foremost, the IRS does impose that 10% penalty for early withdrawals. An early withdrawal is considered one prior to age 59 and a half under normal circumstances. There are specific exemptions to this. We're going to go through a lot of those different options. It used to be only a few. The Secure Act and Secure Act 2.2, excuse me, 2.0 actually added a whole bunch to it as well. So we can go over those one off if you need to dig deeper. And again, the importance of planning and making sure that you mitigate those 10% penalties and kind of tying in it maybe one of those options, none of those options, or a combination of different options that we talk about today that you could see yourself taking if you want to avoid that 10% penalty. So I want to focus on kind of the retirement funds and how you access those and different ways around the penalty. But we look at that number one, age 59 and a half. That's the thing to keep in mind that if you can, you don't want to touch that prior to 59 and a half because that's where that 10% penalty can come into play. At the very bottom here, the RMDs kick in at age 73 or 75, depending upon when you were born. And what that means is whether you need your money or not, at that time, the IRS is going to come knock on the door and saying, "Hey, Wesley, you've saved, you've done a great job, but we want to tax you on this. So we're going to force you to start taking withdrawals out at a certain percentage rate. It's all based upon your age calculation, but generally speaking, roughly about 4% a year, and then it starts to climb up exponentially from there. So it could be that you retire at 59 and a half, retire at 60, 65, and you've got other sources. You don't need to tap into that 401k or IRA. As that grows, that could be a big tax bill growing as RMD time kicks in. So our focus with you is going to be looking at a lot of tax planning structures between those times, between retirement or 59 and a half and age 73 or 75 to help you mitigate that potential RMD. So a lot of that goes into Roth conversion and distribution strategies, how to actually tax efficiently distribute your accounts over time as well. So between those are different options to potentially avoid that 10% penalty if you are under 59 and a half. So the rule of 55, that's a big key one that we focus on a lot because we do a lot of work with 401k companies. So be very careful if you're working with a outside advisor telling you to roll over your 401k if you're between 55 and 59 and a half. We'll talk a little bit more about that. Substantial equal periodic payment, that's the Rule 72T IRS code. We'll go into that in detail as well, but that's going to be setting up a specific income stream and adhering to that, or else you can come back and retroactively get penalized there. Roth IRA contributions. So if you put money into a Roth IRA or a Roth 401k over time, that's after tax money, so it has a cost basis. That cost basis is not going to be taxable. The earnings is what could potentially be taxable if you're not 59 and a half. And then there's some different qualified expenses and penalty-free distributions, which is what we're going to be going over here in a moment as well. As far as getting into the fundamentals of the 72T, that's the one again, that's the SEP, the substantial equal periodic payment, where you agree to a term with the IRS in order to take money out for either 5 years or until you turn 59 and a half, whichever's longer. So let's say if you are getting cut from a company at age 53 and you need to supplement your income where you're deciding, hey, I don't need to spend that much, I'm going to retire now, but I don't want to pay that 10% penalty. Well, then that means you've got 6.5 years, so 53 to 59 and a half, of setting up a 72T in order to stick to the guns and make sure that you don't have any penalties on there. It does require, distribution based upon the IRS methods, which we'll talk about the three different methods that are used. They have gotten a little bit better over the last couple of years because of interest rates coming up, and we'll talk about that as well. But again, you have to stick with that schedule. You cannot change it. If you go in there and make a change or miss it or take more or less, then they can retroactively penalize you. So in that example I gave, somebody 53, and let's say they do it for 3 years, and at 56 they get another job and just stop making withdrawals, then what will happen is those 3 years of withdrawals could have that 10% tax penalty retroactively applied. So you got to be very careful about that. And there's some more things we'll kind of talk about here in just a moment. So take a look at an example. So again, it's an IRS calculation. It's not something that we tell you, or can give you specific numbers on. It's based upon what the IRS does. So we can give you specific numbers, but we don't have any control of those numbers, I guess is what I'm trying to say. So we take a look at this example here. So 72T for somebody, let's say a 54-year-old female, maybe she's got about $900,000 in her IRA. I'll zoom on this for you so you can see a little bit better, but there's really three different methods that we can use. There's the RMD, the required minimum distribution method, in the dark blue. The fixed amortization method, which is what's typically used, the green, and the light blue is the fixed annuitization method. So in this case, for this female, based upon the amortization method rates right now, she could get out about $56,000 under that 72T going forward. So it could be that in this case, that she says, okay, look, I'm retired and I don't want to go back to work and I need about 50 some odd thousand dollars. And maybe she's got, instead of 900,000, maybe she's got a million or 1.2 million or something like that. But we back into the numbers and figure out, okay, if you need 50,000 net, let's say, then it's going to, if we set aside 900,000 of your IRA into the 72T, then that will allow you to get roughly that 50,000 plus some for taxes coming out to you without that 10% penalty. And we still have some other IRA assets that can be earmarked for future expenses if something comes up above and beyond that 50,000. We'll give you an example of kind of how those could play out here in just a moment as well. Limitations again on the distributions, like we talked about on the 72T, they are still taxed. Doesn't mean you avoid taxes. It just means you avoid that 10% penalty. And again, you must continue it once you start in order to avoid that 10% penalty. Like I said before, it can be retroactively assessed to you. So again, somebody starting, let's say at 53, needs to go for 6.5 years. Somebody starting at 57 needs to go past 59.5 and go for 5 years. So again, it's whichever is going to be longer based upon your age. And I know we work with a lot of individuals that retire, let's say at 55, 56, 57, and we're typically going to tell them to avoid this and access their 401k with the age 55 rule we'll talk about in a moment. But in some cases, you may not have that luxury, or you may retire or get cut earlier than 55. So that's where that 72T comes into play. And then again, the early withdrawal does reduce deferred tax growth. So keep that in mind. There's an opportunity cost of taking that money out and letting that versus keeping it in there and letting it grow. But again, push comes to shove, you need the money, you need the money. So that's the reason to access it via 72T. Um, so we talked about the different withdrawal methods. Honestly, just lean on us. We'll give you the right method for that, but I can simplify and tell you that typically it's going to be the amortization method. And that chart we saw before, the last two, the annuity method and the amortization method, were pretty much neck and neck. But usually the amortization method generates a higher amount of income. Again, this is not a guarantee income. This is just the amount the IRS tells you, hey, you can take out of this. So your investments dictate what the growth is and everything. But the RMD is going to be based upon age base. So the younger you are, the lower that's going to be. The annuity method is going to be similar as well, but it looks at annuity rates. And the amortization method is going to look at specific treasury rates plus a multiplier. But the good news is they actually put a bottom or a floor on there where there used to not be a floor. So if we go back to during the pandemic when interest rates were really low, it was really hard to kind of stretch a 72T. But now we've got better interest rates, and so you can split those up and not lock up more. You can lock up less of your assets in that 72T program. I talked again about that example, the 900,000 and maybe splitting it up. So here's a very, very busy example, but just kind of let me walk you through it. This gives you kind of all hypotheticals you can see. But let's say somebody retires, has about $400,000 in their 401k or IRA. Maybe they're 54, so they can't do the age 55 rule at this point. And they say, look, Wesley, all I need to supplement my income or just support myself is I need about $15,000 a year I need to take out. So instead of taking that out, 15,000 each year and paying 10% penalty or 1,500, we might say, okay, are you sure this is what you need? And you're going to stick to this. And if so, we might say, okay, well, we can siphon off $250,000 into an IRA and just do the 72T on that. So that way you've still got the other 150,000 that's available for liquidity if needed be or something else. And so in this case, you can see on the left-hand side, they're taking that $15,000 out for the next 5 years in this case. And as long as they keep doing that, there's going to be no penalty associated with it. If they were to stop, then they could go back and get retroactively penalized. So in this case, maybe they let 2 years go by and they got a new job and they said, I don't need this anymore. And they might have said it's okay to pay the $3,000 in penalty for those 30 grand we took out over 2 years. On the flip side, it could be that they say, okay, well, we're doing this, but maybe something comes along. Maybe there's a storm or an insurance situation or something where you need some extra money. Maybe it's $5,000. You might just say, well, I'm just going to take that $5,000 withdrawal, pay the 10% tax on it, and be done with it. Or it could be that you say, okay, well, maybe it's not something that's one time. Maybe it's recurring. Maybe they had to break down and get a new car. Maybe that new car has about a $500 a month car note on it. So you might say, okay, well, with that 150 I still have, can I split that again? And in that case, maybe you take that 100,000, move it to a new 72T that maybe starts at a different time, but it generates $6,000 a year hypothetically, so 500 a month in order to pay that car note while you're doing it. So again, you're able to go from that 15,000 a year to 21,000 a year without the 10% penalty. You've minimized that. You've also kind of depleted a lot of your flexibility. You've only got about 50 grand or so for emergency fund in there, but it is still available versus locking everything up. And some of the different circumstances were outside of 72T, if it's just kind of a one-time distribution from a 401k or IRA. Like I said, there were just a few before. Now there's a lot. I'll go through some of them, but not all of them. But unreimbursed medical expenses. So let's say if you unfortunately are going through medical treatment and you've got medical expenses that are come out larger than 7.5% of your AGI, your adjusted gross income, then that could be a distribution without that 10% penalty because it's kind of a hardship, if you would. Health insurance premiums are paid if you're unemployed for the first 12 weeks. That's something that's kind of a new benefit there as well. Death, unfortunately, we don't aren't coming to this point, but if you were to pass away, that doesn't mean that all of a sudden the IRS is going to start taxing. If you passed away, let's say at 53, you're going to have that ability to actually transition that over to somebody else, and the distributions would not be taxable, with some exceptions if your spouse were to put it into his or her own IRA, then it goes under their Social Security number, and it could be potentially taxed, actually be penalized under 59 and a half. So you got to be careful about that as well. And then home buyers, this is one that's been around for a while. If it's a first-time home purchase, you can get up to $10,000 penalty free, so you can save $1,000 in that situation as well. That's on both 401ks and IRAs. Some others, disability. Unfortunately, if you become disabled, there are situations where you can avoid that 10% penalty because you're tapping into that. Disaster recovery. This is somewhat a newer one during the Secure Act, but it has to be declared by the Fed. So let's say there's a hurricane or floods or things like that. They will declare that your jurisdiction or your area is part of that natural disaster, and you get up to $22,000 of qualified distributions for something like that. And we've seen in the past where there's back to back where you're hit with two things, so it could be more as well. Education expenses for higher learning for yourself or beneficiaries. There can be some limitations there, but you can avoid some of the 10% penalty. And kind of a last ditch effort emergency fund, not a big one, but up to $1,000 in some cases you can do for emergencies without that 10% penalty as well now. Hardship distribution. So a lot of times, some 401ks may only have a hardship withdrawal while you're still employed. You got to check with that 401k and what those options are. But again, that does not mean that just a hardship withdrawal that avoids the 10% penalty. They may have their own paperwork or their own justification for taking that hardship. If it ends up being one of the ones I just mentioned, then yes, you can avoid that 10% penalty. But if it's just because something different, then it may still be penalized. So be careful about that. Excuse me. Again, like I said, the penalty free does not mean tax free. So again, we're just trying to avoid that 10% penalty we talked about earlier in the slides, that 6 billion that it cost everybody in 2023. So regular distributions from an IRA or 401k, as long as it's the pre-tax portion, are still going to be taxable at your ordinary tax bracket at that point in time. Now, if you've got some after-tax cost base in there, if you got some Roth in there, that's not going to be taxed. And then when we get to the aspect of retiring and rolling over, looking at Roth conversions, there gets into more taxation of that and benefits we can go into with you one-on-one. Non-deductible contributions. So again, after tax, like I said, in traditional IRAs, it may be that you've been saving a traditional IRA outside of a 401k, and you've been putting in, 5 or 6 thousand or something like that for the last couple of years, but you haven't been taking the tax deduction on it. So let's say maybe you put in 15 grand and now it's worth 20,000. So that 15,000 would be tax free. The 5,000 growth is what would be taxable and potentially penalized on there. And then Roth accounts, like I think I just said before, same thing. Contributions are going to be tax free always on there because you're not getting that deduction up front. The earnings, if you tap into that prior to 59 and a half, is what could have that tax and the 10% penalty. So again, it's really important to let that grow because that's really the only option you have for tax-free growth under IRS regulations. So you want to kind of hit that as a last resort. So the age 55, I talked about that before. This is a big one. Like I said before, we work with a lot of different individual companies and help their employees transition into retirement and roll over their 401ks. I'll put this out there. If you're talking to a different advisory firm and you're 55 or older, between 55 and 59 and a half, and that advisor says, let's consolidate everything, let's roll it over to an IRA, you might want to second guess what they're saying because once you roll that to an IRA, you get rid of that age 55 rule. And the only option you have is 72T, which is more stringent. So what is the age 55 for, you ask, Wesley? So at age 55 or the year you turn 55 or later, so you could actually be 54 and turning 55 in December, for instance. If you leave the company during that year, you can take distributions from the 401k plan based upon their withdrawal guidelines, based upon their limitations, without a 10% penalty. So um, let's say that you're 57 years old and you're retiring and you're talking to us and you say, look, I need to bridge the gap until 62, and Social Security kicks in. I want to take it early for some reason or another, and you need to take money out. We'll run through the options and say, okay, well, it may make sense to either leave all or at least a portion of your 401k behind so you can tap into that without limitations. Whereas instead of setting up a 72T for 5 years, you can, maybe you need to take out 20,000 the first year, maybe you need to take out 30,000 the next year, maybe nothing the year after. You've got flexibility there. But keep in mind, you may be limited to the number of withdrawals by that plan. Some allow you once a month, some allow you once a year, twice a year. So it all depends. We need a budget for that as well. And then again, like I said, it has to be when you turn 55 or the year you turn 55 or later. And again, it's exempt from the penalties, but not the taxes. So again, keep that in mind, and that all comes into play when we run a full analysis for you. So limitations on the age 55. Again, I think I talked about some of these, but really it's only for 401ks. This is not something in an IRA, so you need to be careful about that. Again, if you roll over, once you do that, you're foregoing that potential. Also, if you're still employed, it's something that you're not able to do. It's only for those that have been cut or retired the year they turn 55 or later. So if you're, 57 and you say, hey, Wesley, I want to take out a withdrawal without the 10% penalty for my 401k, I'm going to tell you, no, you can't do that. Some other options may be that if you want to access it through a loan, you can take a loan typically up to half of your account or $50,000, whichever is greater. And depending upon what it's used for, there may be differences in how long you can stretch that out and what the interest rates are based upon your plan. But that's something that's tax free. You take that out and you're paying yourself back. So again, you're putting that money back into the account. Now, if you were to, let's say you take out a loan at 52 and you get cut at 54, 53, and you've only paid back a little bit of that loan and you decide to let that loan default, then that could be a 10% penalty on that default. If it goes into age 55 or later and you let default, then we can avoid that 10% penalty that way. Or you can simply keep paying it out of pocket if you want. So again, a lot of scenarios to kind of look at in that case as well. But I've gone through a lot of this stuff. Again, it may or may not apply to you. It may be that a combination of some of these things apply to you. But ultimately, at the end of the day, the best way to look at this is by running a full financial plan. Right now, about three-fourths of Americans over 50 don't have a written plan. You can spend about maybe 5 to 10 minutes, a little bit less, a little bit more, depending upon how much information you already have gathered. And we can put that plan together for you. Give us a couple days. We'll put something detailed, a financial plan or a cash flow analysis to show you what your situation looks like. We can go through and tell you, hey, um, if you're looking to retire at 60, are you on path to do that? Could you retire sooner? Do you need to work another 2 years? If you get cut or and you're looking for another job, we can back into what amount of income you need to get in that new job in order to meet your needs. So there's a lot of different variations we can look through there. And other key things I mentioned, we work with a lot of companies that still have pensions, so we do a deep pension analysis to let you know whether it makes sense to take the annuity versus the pension as a lump sum and things like that as well. As far as kind of wrapping this up and kind of getting back to who we are, the Retirement Group, again, we're an investment advisory firm that focuses on Fortune 500 companies and helping their employees transition in retirement. We've been doing this for about 30 years. Last year, we actually got acquired by Wealth Enhancement Group, an even larger registered investment advisory firm, over $100 billion under management, about 150 plus offices across the United States. So we definitely got some bigger support now. And if you need to sit down with somebody face to face, we can accommodate that easily all across the country. You've also got access to us via phone calls, emails, web communication, whichever your preference is going to be. But again, first and foremost, if you're looking at retiring from a company, chances are we have one of our advisors that is focused on that specific company and knows all the ins and outs So whether it be questions on the 401k, the healthcare benefits, the pension benefits, the life insurance continuation, things like that, we can go over all of that and tie that into that cash flow analysis that I talked about, which actually is complimentary. That's a free cash flow analysis. Obviously, it's done with the assumption that hopefully we go through that and you have questions, you're not working with somebody already, you may decide to work with us, or you may refer somebody to us. So again, it's all complimentary, but with the hopes that we can dig into your situation deeper, help you, and then potentially help you in the long run, or help others that you're aware of as well. So with that, whenever you guys have some time, I'll leave this up here for a while, but you can actually schedule a meeting with us. There's a QR code up there. You can use that to get into our scheduling calendar to set an appointment with myself or one of the other advisors. You can also go on our LinkedIn page, and from there, I think you can actually stipulate your company that you want us to follow. So that way, if you want to get more updates on company specific information like interest rate updates and healthcare changes, things like that, we can follow. We can follow up with you on that as well. You can also reach that info at theretirementgroup.com or 1-800-900-5867. I know we kind of went through that. I have time for two quick questions. It looks like that I'm seeing, so I'll go through those and I'll let you guys go back to what you're doing. So first one, um, I started my 72T 4 years ago, and I have three more left. Can I bump up the uh, can I bump up the amount because of new interest rates? Okay, this is actually a pretty good question. So he said he's 4 years in, got 3 year left, so must have done this about 51 and a half or 52 or something like that. So the question is, it kind of goes back to that slide I had before about no changes whatsoever on there. So 4 years into it, what this person is probably talking about is I mentioned this the Secure Act actually increased interest rates increased plus they increased the floor. So maybe if it was 4 years ago and you ran the calculations, interest rates were lower, and maybe I'm going to make up numbers here hypothetically. A 100,000 IRA might have given you the ability to take 5,000 a year out of it. Well, now maybe you run those numbers, that same 100,000 could give you a limit of maybe 7,000 or something like that. So if this person has something they're trying to bump up, unfortunately cannot do that because again, you can't change it even though the interest rates have changed in there. What you could do is you could look at hopefully that person did not tie up their entire IRA into a 72T. If there's something that's still out there, you could do that option I mentioned before of actually going in there and doing a second 72T if it's something you need some additional income. So on the flip side there, you also can't drop that. If you're 4 years into that and you say, hey, I don't need this anymore, if you drop that, whatever you've taken out those last 4 years, that 10% penalty would be tacked on to that. Okay, good question. One other, unfortunately, this one's saying, um, I don't think I have any withdrawal options in my 401k and I'm still working. What can I do? Okay, well, this is going to be dependent upon each 401k company, so we'd have to take a look at it for you. I'm not going to pretend to know what your specific 401k has, but some are flexible. They give you withdrawal options. Some they don't give you anything until after 59 and a half. Some don't give you anything at all until you separate service. But I would say most, and again, not all of them, but most 401ks give you at a minimum what's called a hardship withdrawal and the loan option. So again, the hardship withdrawal may be something you could access, but they may have their own specific rules and limitations in order to access that. So we'd have to take a look at it for you, or you have to give them a call and find out what that would be. It also comes with limitations where if you do a hardship withdrawal, they may hinder you and say that you can't make contributions for another 6 months or a year or do things like that. So you be very careful about the rules surrounding that. Also, most will have a loan option. So if you haven't already done that or haven't maxed out your loans, there may be an option where you can take a loan out of there. But again, that loan's not a withdrawal, so you're still going to pay that back. So if you're working, you take that loan out and you stretch it out as far as you can. They're still going to make you pay that back, and they're make you pay it back with direct contributions from your payroll. So you don't have any control over that. So again, that may not be what you're looking for because you need access to the money, but now you're in turn paying it back. To offset that, I wouldn't suggest it, but you could review whether or not you want to drop your contributions. Maybe your contributions are about the same amount as a loan payback, and so it could be a net, um, you know, uh, no difference or something there. So I hope that maybe helps. But if you have questions on that, always give us a call or give your plan administrator a call to get in more detail of that. So with that, I want to wrap this up. I want to thank everybody for taking some time with us. Again, even though I mentioned we work with a lot of different Fortune 500 companies, that does not mean we're specifically endorsed or employed by your company. But again, myself and other advisors have worked extensively with many of these companies, so we know a lot of the plans inside and out. We'll be happy to kind of hold your hand, walk you through any process that you need in that retirement planning process. So again, I want to thank you guys. and I hope you have a great day.